Here are 6 of the best tax-free investments you can make in the UK. If you're new to my channel, I'm a qualified accountant and experienced tax advisor. Making sure your investments are tax efficient is crucial to maximizing the returns on your investment. Number 1 is investing through an ISA. ISAs are hugely popular because they're easy to understand, they're flexible, and they're very tax efficient. There are 4 types of ISA that you can open. There's the cash ISA, the stocks and shares ISA, the innovative finance ISA, and the lifetime ISA. ISAs are a tax wrapper, which means that anything you earn on your investment whilst it's invested in your ISA will not be subject to capital gains tax and income tax. And then if you reinvest everything that you make back into your ISA, it means that you can benefit from the effects of compound interest, and that then means that your money can grow faster. You can invest up to £20,000 in a tax year in your ISA, and that's enough for most people. Number 2, pensions. This is arguably the most tax efficient way to save for old age because you are guaranteed a 20% tax saving on anything that you contribute into your pension. So if you wanted to put £100 into your pension, you would do that from your gross salary, but you would effectively only pay £80 of that because 20% of that £100 would not be subject to tax. So the £20 is essentially a government top-up. And there's further benefit because your employer also has to contribute into your pension, and lots of employers will offer an enhanced contribution, which means that they will contribute more than they need to. Pensions used to also be an inheritance tax advantage, but the Labour government changed that in the budget. So pensions are now unfortunately subject to inheritance tax, which means that if you die before you have used all of your pension, the pension scheme will pay inheritance tax on that pension before your beneficiaries have access to the pension, because pensions do now form part of somebody's estate for inheritance tax, whereas they didn't used to before the budget. You can invest a maximum of £60,000 or 100% of your salary into your pension, whichever one is lower. But the downside is that you can't access your pension until you're 55, but that's changing to 57 from 2028. When you draw out your pension, 25% of it can be taken out as a tax-free lump sum, and then the rest of it is subject to tax. Next on the list is forestry investments. This is an unusual one, and historically timberland was something that wealthy families and corporations would invest in. But since then, institutional investors like pension funds started investing in timber, and now private investors can do the same. The idea is that you invest in these timber funds, and then the fund will invest in timber assets. The fund then generates a return by harvesting and selling the timber or other associated wood products. A report by Naveen Natural Capital said that timber had an average return of 9.26% over the past 28 years. This is a long-term investment because it takes years and years for the trees to mature, and the value of timber does go up over time. So it's not something you would expect to see a quick return on. The tax benefit is that there's no income tax on any income generated from the timber, and there's no capital gains tax when the timber is sold, and it's usually free from inheritance tax as well. This is typically a riskier investment, so if you are interested, make sure that you do your research and you consult a financial advisor. Next is premium bonds. This is another form of tax-free investing, and you can invest up to £50,000 in premium bonds, and the effective interest that you earn is tax-free. But you don't earn traditional interest. Instead, you get entered into a prize draw every month and you could win a cash prize. The prizes range from £25 up to £1 million. According to the NS&I, the average prize fund rate is 4.4%. Apparently, 2 people a month will get the £1 million prize, but you could also end up winning nothing. But don't forget that it's not the money that you've invested that you're gambling, it's just the prize rate, which is effectively the interest rate that you're gambling when you invest in premium bonds. Venture capital schemes. There are 3 venture capital schemes in the UK. There's the SEIS, the EIS and the VCT. And all of these schemes allow you to invest in small, unquoted, high-risk businesses in exchange for generous tax reliefs. The investor gets the potential upside of their investment doing really well, and the business gets much needed capital. With all 3 of these investments, you can claim back tax relief. So with SEIS, you can invest up to £200,000 in a qualifying company, and then you can get 50% back of your investment against your income tax liability. So you could receive a £100,000 income tax relief benefit from investing in an SEIS company. And then when you come to sell your SEIS qualifying shares, if you've made a profit, that profit would not be subject to capital gains tax. There are lots of conditions that a company and an investor both have to satisfy in order to qualify for any of these reliefs. So it's important to get the proper tax advice. It's also important to say that these investments are all typically very risky because you are investing in very small early stage businesses. And so it might be better for an investor who's already maxed out their ISA and their pension and who's looking for something else to invest in. Number 6, dividend paying shares. On the other end of the scale, if you're quite new to investing, then make sure you are making the most of your dividend allowance of £500. This means that investors can earn £500 of dividends before they have to start paying tax on them. A dividend is your share of a company's profit, which you receive for investing in that company and then holding on to your investment rather than selling it. You can also invest in dividend paying funds rather than individual companies. There are lots of companies in the FTSE 100 that traditionally do pay dividends. So there's BT, Lloyds Banking Group and Diageo. But remember that companies don't have to keep paying dividends just because they have in the past. So if one year a company's expenses are quite high, it might decide to reinvest all of its profits rather than paying them out to investors. Next on the list is buy-to-let. This one isn't tax-free completely, but if you are a higher or additional rate taxpayer, then consider buying any rental properties through a company rather than owning them individually. That's because companies can deduct their mortgage interest from their taxable profits, which in turn reduces the tax that has to be paid on the rental income. Individuals instead get a 20% tax credit for their mortgage interest. It doesn't matter for basic rate taxpayers because they will get a 20% credit for the mortgage interest anyway as an individual landlord. The difference really matters if you are paying tax at 40% or 45%, because then the way to get the full deduction of the mortgage interest is to make sure that you hold that property in a limited company so that you can deduct it in full. Make sure you subscribe for more content like this. I'm currently posting videos every couple of weeks, so I will see you next time.